So equities in the news. Here, what Greg's going at here is, the Fed said opened their big mouth and stated the obvious. There is some very rampant inflation right now. They had said going into it, was it transitory inflation, meaning was it a temporary situation due to some external factors, and it appears as though this inflation is a little more than external, and some of the other factors that are causing it could be here to stay for a little while. So the Fed is reacting, and how you see the Fed reacting is, of course, they raise their short-term interest rates. And what I want you to look at here on this chart, this like pink purple line here, that is the price of the 10-year note, the 10-year futures. The price of the note is inverse to what's going on with interest rates. So what most people don't realize is that the 10-year note has a par interest rate, or an interest rate they pay. So they're going to pay, like, I think 5%. And when interest rates are below that 5%, you're willing to pay more than, so this is interest rates on a $100,000 bond. You're willing to pay more than $100,000 for that because you want to get 5% interest as opposed to what you could get in the regular market, which recently was down at 2%. So as interest rates start to go up, you're willing to pay less for that 5% interest rate because you can get more interest in other parts of the economy. So people are paying less for bonds because their interest rates are going higher. A couple other things we want to take a look at here. We're looking at the Nasdaq is in blue here. So the Nasdaq, this is the beginning of the year, right around here. Since we're lower on the year. In fact, we're heading back to the low we saw there in March. But Nasdaq came off, had a nice little bounce in March, peaked out right at the beginning of April, and it's been kind of all downhill since the beginning of April. Dow Jones has been this is the green line, it's been a little more flat. I think what's really interesting to me is crude oil. And crude peaked right here at the beginning of March, and that was obviously in response to the war, the Russian-Ukraine war. But since then, it is really trending more sideways. Seems to put a floor in, but it keeps bouncing off a level and not making another higher high. So patterns like this could tell me things are getting a little toppy. S&P 500 here is in the black, very similar to the Nasdaq, of course. And, it's made its peak at the beginning of April, and it is rolled over as well. And then we can see lumber here is our orange line, bottomed out there about a week ago, and seems to be bouncing up here a little bit. So these are just some alternative indicators to look at. The top one here is the equity put call ratio. This is just going back to equities, and it's the ratio, the number of puts versus calls. And right now the ratio is quite a bit. It's on the top end of its recent range. This is yearly, so you're going back to here's back to the year 2000. And you can see in times of massive recession, so in 07, 08, in that the Great Recession, we had put call ratios that were much higher than we are right now. Here is 2020. This is the beginning of the pandemic. Put call ratio got pretty high, but this could definitely be sounding some alarm bells. It's up on the higher end. The investor intelligence bull bear ratio. This is down at as low as it goes. Investors seem to be a little bearish. All right, moving along. And this is the market implied probability that the Federal Reserve was going to raise its benchmark interest rates, and to a range of at least 2.5% to 2.75% by the end of 2022. You can see this is the beginning of 2022. and no one thought, basically no one thought we were going to go to 2.5 to 2.75%. Then all of a sudden the Fed, opened their big mouth and it jumped. Had a 80% thought that we were going to get to that range. Had a slight pullback, and now basically everyone that has been surveyed, I guess, on this is thinking we're going to be in the 2.5 to 2.75% range by the end of 2022. All right, so these are the percent change. So this is measuring some volatility. Lumber is right up here, up 7.5%. But this is the VIX, and the VIX is a measure of volatility. It's basically a measure of the price being paid for options in the equity market, and it's up 20%. The Russian Ruble is up 8.5%. And you can see some of the big movers. We have canola, soybean, ethanol, a little rough rice. But even as much action as the bond market has had, it pales in comparison to some of these other futures contracts. All right, so this is an interesting chart, and really what it's kind of telling us historically, how the lumber market has a bit of a cycle or a flow. And this, what it shows is in the late fall, people tend to buy inventory and accumulate inventory because it's easier to store, one reason. And then they sell that inventory into the market. So as everyone is buying the products to get into the spring building season. So we, historically have seen a peak around Feb, March, and then there's a dip in May, June. Good inventory buying, accumulation. That inventory gets sold at the end of September. And, we're seeing a break going into Q4, and then in Q4, people buying again. The green line here is the cash market. He says 20-year average. You'll see it said this is actually wrong. This is like the last 3 years. And what we can see is that indeed there was the peak of the market where people sold off their inventory that they bought in February, March. It kind of stayed high. We didn't get that seasonal dip in May, June, but we definitely got the seasonal dip in late October, December. All right, so now we're going to just take a look at what the heck is going on right now. This is a weekly continuation chart. So the peak right here was May of last year, so you're just over a year on this. And what jumps out at me in this is that, number one, we didn't take out the high, but we haven't taken out the lows of last fall either. So what does this tell you? It's a sideways market. And, if you look at it, you can see where, maybe we're about the 50 percentile of this this whole move, I would say. Yeah, we're right in the middle of the big down move from May all the way into the end of summer of last year. So I think it's just showing that we're kind of a sideways market, although very volatile, moving up and down, but sideways. So here's the May daily, and I actually have another chart I want to show on this because today, which the bar is not on here, we actually rallied today, and we've taken out this this high right here. So we've broken this channel. Greg drew in a nice channel here. The down channel has been broken. We could look at July, and you could have said that the July down channel was broken a few days ago, but July was definitely the first mover here. May took a little bit longer to get going. July definitely outpaced it. And now we're going to start looking at basis. Well, before we do that, I'm going to take a look at these charts. So these are today's. These are up to the minute here. This is the May futures contract, and I have today's bar in here. And yes, you can see that this was that nice channel. Essentially, it was broken on Wednesday, just a week ago. We came up. Monday opened up. We actually touched limit down on Monday, which was pretty interesting. Very low volume, not a lot of activity, but we touched limit down, and we've come firing out of that pretty significantly. In May only, though. Now we take a look at July. July pulled back, and we left a little gap here, but July is significantly lower, and it's a different looking chart than the May, and this reflects in the May-July spread. So everything was looking pretty orderly here, kind of compressing the 2 months together, and then in the last really 2 days, we've seen this spread go from, it was a low of $45 to the high today is $135. So that's a pretty unprecedented move. $90 move in the spread in 4 days. Basically what it's telling you is May, moving into its expiration, is decoupling from the July market. Get rid of that and go back to this. Why won't you move? Come on. I am having a challenge to get this to move. I have to get this silly bar out of the way. So if you give me just 1 second, I can get that bar out of the way. Here's a little trick for you guys. If you end up with the taskbar not disappearing for you, you go Control-Alt-Delete, go to your task manager, and restart Windows Explorer. There we go. Now I can get this back up here. All right, sorry about that. So now we're going to look at basis. This is from the 19th of April. The basis, meaning the difference between the cash and the futures price, was running around a little over $100, saying that the cash market was $100 over the futures market. Then we look in, as of the 26th, the cash market had come down and it is almost even. We're just around $25. This is the cash price to the May futures. And you can see it was $81.10. Year ago was $121. 2 years ago it was -9. So then this was last week, $81. This week, $25. Essentially, I think you can call that convergence. You look at July. July was 152 a week ago. July stayed a little more stubborn out there, around 126, because as the cash market has fallen, so has the July market fallen. SEP 175 down to 165. SEP is falling with the cash market. What this is telling you is you're not able to buy cash today and sell futures as a hedge against it and lock in a profit. This is a forward pricing. If you want to buy something for a September shipment, your best bet today is to buy lumber futures versus the Western SPF product. Now, you can make an argument that we don't have it up here, but Southern Yellow Pine, maybe Southern Yellow Pine is reflecting that it is you could buy Southern Pine and sell futures. This is that May, July. Remember I just showed you? It was pretty orderly, moving lower, and then wow, it popped right up. But is this unheard of? No. Let's take a look. Back here is the May, July of last year, and what's interesting about this chart is you're looking at this time, right about now, it really fell out of bed and then bounced into the expiration. But the one thing you know is as you approach expiration, the futures contract that is expiring becomes more like the cash contract, and it decouples essentially from the next expiration. So here it's decoupling from July. Now the things are a little more orderly in the July SEP and the SEP Nov. So let's take a look at what's happening with open interest. The volumes have been relatively light as of late, and so this is on April the 17th. Open interest was 2,784. We go to the 25th. Open interest was 2,835. A slight pickup. The important thing to note here is, so the July contract is now the lead contract as far as the open interest goes. And what we'll see is this May contract the open interest or the number of contracts open will continue to fall as we get closer and closer to that expiration. And now we got to look at the commitment of traders report. So this was as of the 12th of April. And, the thing that really jumps out to me is half of the open contracts are short positions by industry players. And that generally means they are positioned against a physical inventory. This side, the long position, is, you could argue it's almost half, it's about 40%. This is a long position against future business. So you could say that these are less fat, we call them fast money. These positions are less likely to be taken off or traded out of. Then as you move over to the managed money, much smaller position, especially right now. And there's nothing remarkable here. It's kind of even long to short. I think the only remarkable thing is, remember, this had been a pretty big number, and managed money's just kind of exited the building. There's not much to going on there. Other reportables, lightly long, and then non-reportable positions. So these are your small traders. In lumber, I think it's anyone that has a position less than 20. It's pretty evenly balanced as well, long versus short. But there's quite a few traders over there. Here's something that I think is kind of, well, let's go to the next. So now we're going to jump over here. As prices came down, there were more forward pricing was done. So you saw a pickup about 100 contracts in the industry longs. Interestingly enough, as prices have gone down, the producers added a little bit. Managed money is liquidating their positions. They're probably getting stopped out of their positions, and not much else has changed. But I look here, and you could say that you've got 23 traders are really affecting, I'd say, 50% of the overall market. So that's a lot of people like to look at futures. Not as many people are actually active in futures. All right, so this is one of, I think, probably the most important charts of the day. And this is rail car velocity. So what it's saying is the wood's moving faster. The rail cars are moving faster. Obviously, these are the last 2 years. It's at this time of the year. This is a late winter. There's definitely some rail car issues, but we're right at normal. And so I think wood should be moving through the pipeline pretty easily. This is the Canadian carloads, intermodal shipments from Canada and forest products. This one surprised me a little bit. We're definitely lower than we were in 2020 and in 2021. So while the cars are moving faster, if we wanted to see the market come lower, we want this to be back up to the normal side here. I know personally here at Materials Exchange, we're seeing trucking is loosening up a bit, which that's a good thing. Now this is the United States rail traffic, and here I think you're seeing everything looks pretty normal. Although I'd like to see this line moving higher, it's actually moving lower. But all in all, I think rail traffic is okay. There's nothing significant that's jumping out at me. All right, so that kind of wraps things up for today. Just to give you a few things that are happening in my head about looking at the market. I'm paying a lot of attention to the price difference between Southern Yellow Pine and the spruce market. And I'm paying attention to the price difference between European wood that's hitting the eastern seaboards, particularly in Florida, and some of the prices that we're seeing for domestic North American wood in the northern part of the United States. So Southern Yellow Pine, for instance, 2x6 16-foot Southern Yellow Pine is running, truckloads are being offered around $700. At the same time, 2x6 16-foot in spruce is being priced around $1,100. And 2x6 16s traded yesterday on the platform in euro at $900 down in Florida. So, that's just one item where there's significant price spread. And while I don't know that those Southern Yellow Pine 2x6 16s are as interchangeable with spruce, in some instances they are. The other thing I looked at today, which I found really kind of interesting, the wides. Southern Yellow Pine wides were considerably less expensive than spruce wides. So those are the few things I've been paying attention to. I'm looking, for the between now and next time we talk, that'll take us into May. May will have no limit starting on Monday of next week. And we're going to see continued open interest decline in May and pick up in July. So July will be kind of the topic du jour then. All right, so that wraps it up. We'll be back with Greg Kuda next week. If anyone has any questions between now and then, reach out to me. If you want to see the presentation, you want us to email it to you, we can email it as well. Just reach out to me. So have a great week. We'll talk soon.